Hi, welcome back. In this session, I'd like to focus on activist growth investing. If you remember, in the context of value investing, we talked about activist value investing, where private equity investors and others come into a company, take a position, and then try to actively change the way the company is run. In active growth investing, that role is usually played by venture capitalists who come in and provide capital to young startups and young growth firms and then try to mold the way those firms grow, sometimes in good ways and sometimes in bad ways. So let's get the process started. If you look at the face of activist growth investing, it usually takes the form of venture capital. But venture capital is just a term. Prior to the existence of venture capital as we know it, there have always been people who've invested in young growth firms, private individuals, wealthy people, institutions. What do they hope to get? They hope to have success in getting that young growth firm become a large, mature firm and reap the harvest. So if you look at activist growth investing, the most common form is investing in young startups. Venture capital is provided, but increasingly over time, public equity investors have entered the space as have wealthy individuals. It is also possible, but very uncommon, it's very possible that there are some growth companies, publicly traded companies, which have run into issues with their growth investing, where an activist investor, like a private equity investor, comes in and changes the way that publicly traded firms run. Uncommon, and in the case of growth companies, you're far more likely to see activist investing take the form of venture capital. So let's take a closer look at investing in private equity in all of the different forms. As I said, venture capitalists have their history in the US going back to the 1950s. One of the first was American research, and over time, US venture capital has been way ahead of the rest of the world in being able to provide seed money to young startups. In the 1980s, there's private equity in the form of leveraged buyouts, but they didn't look at young growth firms. They looked at mature and declining firms. And as we talked about in an earlier session, private equity funds have exploded as the desire for alternative investing has come from that end game of clients wanting to invest. As the private equity business has exploded, you also saw the alphas and the excess returns fade away. In this session, I want to focus primarily on the venture capital process. So let's take a look at how the venture capital process works. Let's say you're an entrepreneur. You have a startup, it's doing well, you have lots of promise, but you need capital. You approach a venture capital. You make a pitch and you get the venture capitalists in. That's the first step in the process, right? A young startup getting the interest of the venture. Now, in some cases, it's not you seeking out the venture capitalists. The venture capitalists might seek you out because they've heard that you have promised. That's the first step, though, is that connection. The second step in the process, the venture capitalist tries to put a price on your company. Keyword is price, not value a company, as we'll see in a minute or so. There's very little valuation in venture capital. It's all about pricing, and we'll talk about the basis for that pricing. And why do you need a pricing? Because if a venture capital is going to invest money in your company, the proportion of your company he or she will demand in return will depend on the pricing of your company. Now let's take a simple example. Let's assume you're seeking out 100 million in venture capital. To determine what portion of your company you want to give up in return for the 100 million, you've got to come up with a pricing for the company. If your pricing for your company is 500 million, the 100 million will give the venture capitalist a 20% stake. Already you can see pricing is going to be this issue where founders and venture capitalists are going to be pushing from opposite directions. Incidentally, in venture capital, there is this distinction that's drawn between pre-money and post-money pricing. At the risk of getting into quicksand here, let me give you a very simple way of thinking about the difference. The pre-money pricing of a private business is what that private business is worth if it continues on its existing path without getting the venture capital influx. The post-money pricing is what that same business is worth with the venture capital influx coming in. Now you're saying, what difference is the venture capital influx going to make? At first sight, there is a very simple change that happens, right? If I raise 100 million from venture capitalists, the minute after I do that, I've got 100 million in cash. So many people, when they talk about pre-money and post-money pricing, all they do is they price the company and then they add the cash raise in the venture capital round to that pricing. It's a lazy way of distinguishing between pre and post money pricing. You're saying what's the right way to do it? You actually have to the funds coming in, which means it might grow slower. It's going to be a different business. And then you revalue the business with the money coming in, opening doors to maybe more growth and more ambition. Pre-money and post-money pricing captures that difference in addition to the cash influx. Second, once you seek out that venture capitalist as a founder, that money is going to come with strings because the venture capitalist is part owner of the company. They're going to put constraints on not just how you run the business, but how you raise additional capital. Think about it. If you invest in a startup and you don't constrain the owner can very quickly undercut you by going out and raising fresh equity and giving them an earlier stake, a better stake than you do. So venture capital, in addition to providing money to a company and getting a percent of the company, will put in restrictions on future capital raises. And those constraints might come into play as you try to grow. That's the process of venture capital. Let's talk about how venture capitalists price startups. The key word, as I said, is pricing. If you remember the way we price things, we look at other things just like the thing we're pricing and what people pay for them. In the context of venture capitalists, it's usually pricing a private business. You look at other private businesses that other venture capitalists have priced. So you can look at pricing of similar companies. That's one basis. So if you're putting your money in an AI firm, you could look at 50 other AI firms and see what venture capitalists have priced the firms at. One of the problems you're going to have in pricing these companies, especially early in the process, is they don't have the financial metrics you usually scale the pricing to. Remember, you divide by earnings, which you're definitely not going to have with the startup. Even revenues might not be there. So often you get desperate. You divide by price per user, price per download, price per potential market, but you scale the pricing. The other thing you can do is look at recent pricing of the same company. If you take a company like Uber, which had 10, 12, 15 rounds of venture capital, the most recent venture capital round might have been 3 months ago, and those people might have priced the company at 100 billion, in which case that's going to be a starting point. Pricing of similar companies. But ultimately, if your end game is to go public, you're going to be looking at the pricing of public companies. Staying in the AI space again, if publicly traded AI companies are being priced at 50 times revenues, that's going to feed into your pricing of private businesses in that space as well. But it's all pricing. The notion that venture capitalists sit down and go through business models and value companies is false. That's not what they do. In fact, one common variant of venture capital pricing is a forward pricing. Why do you do a forward pricing? Because as I said, most startups don't have much of substance now. No revenues, no earnings. So you project out into a future year when you think they will have revenues. So let's say that in year 5, you expect your startup to have $100 million in revenues. It's an expectation. You apply a multiple to those revenues based on what? Based on public companies, based on other companies that have revenues right now. Let's say those companies right now trade at 5 times revenues. You take the 100 million, you multiply by 5, you get your expected pricing in year 5, $500 million. You're almost there. You need a pricing today. What do you have to do? You have to bring that money back to today. Venture capitalists apply what's called a target rate of return. Looks like a discount rate, acts like a discount rate, but we're going to talk about why it's really not a traditional discount rate. But you discount it back to today. Because as a venture capitalist, here are the things you worry about. That the company might not make it, that there might be additional cash required and more capital raised. So all of those things are going to play into the target rate of return. So you discount back that 500 million today using the target rate of return. The higher the target rate, the more the discounting effect is going to lower that number. In some cases, you just compute an IRR based on that number to see if you're earning a reasonable return. So already you can see the game that goes on. If you play the role of the founder and I play the role of the venture capitalist, remember your end game as the founder is to push up the pricing so you can end up giving up less of your company. And my objective as a venture capitalist is to move in the other direction. So I'm going to push for lower expected revenues in year 5, a lower multiple and a higher target rate, and you're going to push for the exact opposite. That's how venture capitalists put a number on companies. And that, of course, is kind of this amorphous number. Is it pre-money or post-money? Because it's such a back of the envelope calculation, I'm not sure what you priced when you did this. So it's kind of messy. So when you see pre-money and post-money pricing, remember you're working off a number that's a back of the envelope number, for lack of a better description. So let's say you've negotiated a pricing, you've given up a stake in your young company to a venture capitalist. The venture capitalist doesn't go away. In fact, venture capital investing cannot be passive investing, where you put your money in a company and just walk back and live the rest of your life. You've got to take an active role, because if you don't, you're going to get ripped off. So to begin with, there's some good stuff that venture capitalists can bring into a startup. They can bring in management experience, building supply chains, the kind of knowledge about building a business you might not have as a founder. They can come with a Rolodex, using an old-fashioned term, or a contact list that'll allow you to raise more capital. So there's that post-deal component they bring in. But as they're doing all of this, venture capital is always checking out the exit door, because to make money as a venture capitalist, you have to do one of three things. One is you take the company public. This is the most glamorous exit, because your small private business becomes a public business. Your 20% stake in what used to be a $1 billion firm is now a 20% stake in a $100 billion firm. That's an initial public offering. You're saying, why doesn't every startup do this? Because it might not be an option for your startup if you don't get to that scale. Right? Usually venture capitalists don't liquidate their holdings at the time of the offering, but they're looking for an exit nevertheless, 6 months, a year, where they can dump their share or reduce their share. The second alternative is to sell the private business to another firm, publicly traded or otherwise, at a price hopefully higher than the price you estimated at the time you entered. The third alternative, it's uncommon, is let the private business run as a private business, and as it matures, it throws off cash flows, you collect the cash flows. It's unlikely that this is going to be a great return strategy, but it might be a strategy for some of the investments in your venture capital portfolio. So the pricing, you got the post-deal management. But let's talk about the biggest risk in venture capital. This graph, which comes from the Bureau of Labor Statistics, which tracks the number of startups in the US and then tracks what happens to them by sector over time. Take a look at all firms, right? You start off with 100 firms. By the time you get to the end of year one, you have only 80 firms. You're saying, what happened to the other 20? They failed. In fact, by the time you get to the end of year 7, almost 70% of the companies you start with have failed. To venture capitalists, this is your prime risk. Many of the startups you invest in will never make it. You're saying, I can liquidate them, and get what? Many of them don't have assets you can sell, right? You're probably going to get nothing from your investment. So when you're a venture capitalist, you worry about this constantly. And then you try to bring it into the analysis. And there are two ways venture capitalists try to do it. First is by hiking up that target rate. And that's why I said it's not quite a discount rate, because it becomes this mechanism that venture capitalists use to capture survival risk and cash burn risk and everything else. So the more worried you're about failure and survival, the higher the target rate becomes and the lower the value today becomes. You also try to bring it in other ways, in backdoors, by using more conservative estimates of revenues in the future, lower values for the exit multiple. But all of those things are helping you become more conservative in your pricing and demand a higher stake. Of course, founders will push back in the opposite direction, but it's a venture capitalist way of dealing with survival risk. And as I said, target rates of return are concoctions. In a typical discounted cash flow valuation, a discount rate is supposed to reflect the risk in an ongoing business. In fact, discounted cash flow valuation is designed for going concerns. It's not designed for survival risk. And the problem with target rates, it becomes a blunt instrument. You just puff it up to include all of these other worries. It becomes a receptacle for all of your fears. Now, of course, venture capitalists charge different target rates for different kinds of VC investments. Angel investing, which is very young companies, you might demand a much higher target rate than investing in startups that are further along the road to developing a business. But in general, venture capital target rates, if you take a look at them, and they're out in the public domain, look very high, 40, 50, 60, 70%. And therein lies one reason that the myth of venture capitalists being great investors is born, because you look at those target rates and say, these guys must be amazing. How the heck do they earn 50, 60, or 70% returns? The answer is they don't. In fact, if you look at the actual returns that venture capitalists earn, they're very ordinary. They look very similar to what you and I make investing in the S&P 500, what private equity investors make. In fact, over very long time periods, venture capitalists have earned. So if you look at a 20-year time period, they've earned about 1.2% more than the S&P 500. And definitely less than what those target rates are. So when you see those target rates of return and you discount that terminal price back, be very careful. This is not a discount rate in the conventional sense of the word. You won't be able to explain it using any of the traditional metrics. It's a bargaining device used to capture survival risk and other risks that venture capitalists worry about. So on average, venture capitalists are not super investors. They're pretty average investors. And if you look by group at early stage, late stage, at every stage, let's start with in individual years, you might have great years, but if you look at longer time periods, you look at all venture capitalists, they earn about 18%. That's good, right? Over a 20-year period. Early stage venture capitalists earn the highest returns, but then you get to later stages, it starts to look very much like public equity. You look at the table, you're saying, I'm going to be an early stage venture capitalist. That's where the big returns are. A caveat. One is, those returns at early stage investments tend to be incredibly skewed. What I mean by that is, if you have 100 very young startup investments, you'll be lucky if 20 of them pay off. And the 3 or 5 that pay off the most pay off in such a big way that they make up for the rest. This is true in venture capital portfolios. Venture capital portfolios are not built where you get most of your investments paying off. It's those big payoff investments. Now, if you use the terminology of finance, there's a lot of optionality here. Venture capitalists invest in options rather than traditional businesses. And the options that pay off are deep out of the money options. So they pay off big time and they make up for your losses on all of your others. So as you look at startups and late stage investments, you're going to see that, especially with startups, it's very skewed. It gets less skewed with late stage. And the later you go in the life cycle, the more symmetric the distributions start to become. So on average, venture capitalists look average, deliver returns that look very much like average public market investors. But if you look at the biggest winners in venture capital, they tend to get those gains by being in, as an example, benchmark capital, investing in Uber at $1 billion pricing. Company goes public at $100 billion. That's the kind of investment that delivers the returns. Now, one thing that you can say in venture capital's favor is, unlike in other aspects of investing, the most successful venture capitalists tend to stay successful. As opposed to what? The most successful public market equity investors keep flipping, right? They go from one year to the next year. There's very little continuity in investing in other spaces. But in venture capital, there seems to be a lot of continuity. There's something about the venture capital business that allows the most successful venture capitalists to have durable competitive advantages that allow them to keep winning. And what might those advantages be? One is perhaps they're better pricers than the rest of the tribe. Or perhaps, and this might also happen, once you get successful, private companies want your money so much that they offer you better pricing. So if you're one of the top venture capitalists and I'm a startup, I might come to you and offer a share of my company at a much better pricing than I demand of other venture capitalists. So whether they're better prices or they just get a better pricing, you start at a much better spot if you get a bigger stake in a company for a given venture capital investment. Second, they can influence the pricing game. If you raise money from one of the top venture capitalists, it makes it easier for you to raise more money. Now, SoftBank has had a very mixed record in venture capital, but the fact that they have so much money to invest, it means that once SoftBank invests, other VCs line up to invest as well because they know there's more money where that came from. And I think the very best venture capitalists are like the very best traders. They have good timing. What does that mean? They get in at the right time, they get out at the right time. I like to tell the story of Mark Cuban, legendary venture capitalist, right? But if you look at that legend, he created a company called broadcast.com that he sold at the peak of the dot-com boom for $5 billion. You know what happened to broadcast.com? In the aftermath of the dot-com bust, it went away. If we judge Mark Cuban based on the quality of the business he built, not a great business, right? But if you judge him as a venture capitalist, he's a great venture capitalist because he got in at the right time, he got out at the right time. The very best venture capitalists share the same kinds of characteristics. The very best traders, they get in at the right time, they get out at the right time. So if you decide to go this route of investing in young startups, the key for you is to pick the companies you invest in well. And because these companies are informed, you care more about who's running the companies. Good founders / managers matter a lot more because they're the ones who are going to build the business. The very best venture capitalists are better judges of people than average venture capitalists. You got to spread your bets. As you saw, it's a very skewed distribution where a few big winners carry you. So you got to spread your bets. If you put all your money in one startup, God help you. You got to spread your bets, preferably across different types of, even if you're a tech venture capitalist, spreading it across all aspects of tech rather than just AI is better for you. Third, your job doesn't end. You got to be a consultant, you got to be an advisor. In some cases, you might actually have to push founders out and bring new people in if the founder is incapable of building a business. Fourth, you got to protect your investment as the firm grows and raises more capital. So there you got to make sure you put in protections when you invest. So when the company goes out and raises more capital, you can make sure the terms on that capital don't undercut you. And you have to know when to get out. A good exit strategy is what's going to make you successful. If all of those things work in your favor, a venture capital route opens up for you. I hope you found this session useful, and I thank you very much for listening.